Welcome to today's video on the IRA rollover trap and why high earners must avoid mixing retirement funds. In the next few minutes, we'll break down the Backdoor Roth strategy, the IRS Pro Rata Rule, and the optimal moves to keep your tax plan intact. Let's begin, and then we'll move into the agenda to set the stage. Here is our agenda. First, we will define the Backdoor Roth. Next, we will explain the Pro Rata Rule and why it matters. Then, we will reveal the common rollover mistake that derails high earners. After that, we will cover optimal strategies, an underappreciated Rule of 55 benefit, and concrete action steps. Finally, we will test your knowledge with a couple of quick quizzes. Now, let's transition to a quick primer on how the Backdoor Roth works. The Backdoor Roth is a two-step process that allows high earners who exceed income limits to effectively fund a Roth IRA. First, you contribute non-deductible dollars to a traditional IRA. Second, you immediately convert those dollars to a Roth IRA, typically minimizing taxes because the contribution was non-deductible and there is little or no growth before conversion. However, this process only works efficiently if you do not have any pre-tax balances sitting in traditional, SEP, or simple IRAs. With that foundation set, let's transition to the core problem, the IRS Pro Rata Rule. The rollover trap happens when you move old 401k funds into a traditional IRA. That creates a large pre-tax IRA balance. Under the IRS Pro Rata Rule, when you convert any amount from a traditional IRA to a Roth, the taxable portion is calculated across all your non-Roth IRAs in aggregate. For example, if you have $100,000 in pre-tax IRA funds from a prior rollover, and you add a $6,000 non-deductible contribution, and then convert $6,000, approximately 94% of that conversion becomes taxable, because the ratio of pre-tax to total basis drives the calculation. This effectively defeats the purpose of the Backdoor Roth strategy, and can lead to a surprise tax bill. Now that you see the trap, let's check your understanding with a quick quiz before we talk about solutions. Question: which action most often triggers the Pro Rata Rule problem for high earners using the Backdoor Roth? Options: A. Leaving funds in an old 401k. B. Rolling a former 401k into a traditional IRA. C. Contributing non-deductible dollars to a traditional IRA. D. Converting immediately to a Roth IRA. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Rolling a former 401k into a traditional IRA creates a pre-tax IRA balance that triggers the Pro Rata Rule during any Roth conversions. This causes a large portion of the conversion to be taxable. Next, let's cover the optimal strategy to avoid this trap. There are two strong ways to avoid the Pro Rata problem while preserving the Backdoor Roth strategy. First, if your current employer's 401k accepts roll-ins, move your pre-tax funds there. Second, consider leaving the funds in the old 401k plan if the investment options and fees are acceptable. The reason this works is that 401k money is not considered in the Pro Rata Rule calculation, which only counts non-Roth IRAs. As an added benefit, a 401k can offer the Rule of 55. If you separate from service at or after age 55, you may access those funds without the 10% early withdrawal penalty. With those strategies laid out, let's visualize your annual process with a timeline diagram. This timeline emphasizes a clean annual cycle. Make your non-deductible traditional IRA contribution early in the year, convert to Roth immediately to minimize any growth, confirm by December 31st that you have no pre-tax balances in any non-Roth IRAs, and then file Form 8606 the following year to track basis and conversions. Next, to reinforce decision-making, let's explore a mind map of choices that keep your Backdoor Roth pathway clean. This mind map centers on keeping your Backdoor Roth pathway clean by segregating pre-tax funds. You can do this by rolling pre-tax dollars into a current 401k plan or leaving them in the old 401k. Avoid commingling pre- and after-tax dollars inside any IRA intended for Backdoor Roth use. The benefits of this approach include access to the Rule of 55, potentially stronger creditor protection depending on jurisdiction, and in some cases, lower institutional fees. Now let's translate this into clear action steps you can follow. Follow these steps. First, confirm you are over the income limits for a direct Roth IRA and need the backdoor Roth. Second, inventory all your non-Roth IRAs and note any pre-tax balances. Third, review your current employer's 401k plan to see if it accepts inbound rollovers. Fourth, isolate pre-tax funds by moving them into an eligible 401k or leaving them in the old 401k. Fifth, make a non-deductible traditional IRA contribution and keep the documentation. Sixth, convert to a Roth IRA immediately to minimize any taxable growth. Seventh, before December 31st, verify that your non-Roth IRAs do not have any pre-tax balances. Eighth, file IRS Form 8606 to properly report your basis and the conversion. With steps in hand, let's compare best practices with common pitfalls. On the left are best practices. Keep pre-tax funds inside a 401k, execute the non-deductible IRA contribution followed by a fast conversion, document basis with Form 8606, and verify a zero pre-tax IRA balance by year-end. On the right are pitfalls. Rolling pre-tax 401k money into a traditional IRA, delaying the conversion and allowing growth to create taxable exposure, failing to document basis, which risks double taxation, and ignoring your employer plan rules or the pro rata mechanics. Next, let's present a quick comparison table of where assets can live and why. This table compares where to house pre-tax dollars. Both current and old 401k plans avoid pro rata risk because 401k balances are not counted in the IRA aggregation for conversions. Fees and investment options vary by plan, but institutional pricing can be attractive. The Rule of 55 applies to 401k plans if you separate from service at age 55 or later, while IRAs generally do not offer this early access without penalty, except under other specific exceptions. Creditor protection is often stronger under ERISA-governed 401k plans than under IRAs, which vary by state law. Administrative complexity differs. 401k plans are governed by employer rules, while IRAs place the administrative burden on the individual. With the comparison complete, let's deepen the math with a concise Markdown walkthrough. Let's run the numbers. Suppose you have $100,000 of pre-tax IRA funds and you make a $6,000 non-deductible contribution, then convert $6,000 the same day. The simplified pro rata calculation is the pre-tax portion divided by the total IRA balance multiplied by the conversion amount. With $100,000 divided by $106,000, about 94% of the conversion becomes taxable, approximately $5,640. The clean strategy objective is to keep your pre-tax IRA balance at zero by year-end, typically by using a 401k to hold those pre-tax dollars. That way, the taxable portion of your backdoor Roth conversion approaches zero, aside from minimal growth. Now, because we are talking about taxes and retirement, let's include a quick but important disclaimer. This content is educational and not tax, legal, or investment advice. You should consult a qualified tax professional or fiduciary financial advisor for guidance tailored to your situation. Tax laws and employer plan rules change, so always verify current regulations and read your plan documents. With that noted, let's test your knowledge one more time. Question: what is the cleanest way to preserve the backdoor Roth if your current employer plan allows it? Options: A. Roll 401k funds into a traditional IRA. B. Convert everything to Roth immediately, regardless of balances. C. Roll pre-tax funds into your current 401k. Leave all funds in a taxable brokerage account. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. Moving pre-tax dollars into your current employer's 401k ensures those funds are not included in the IRA aggregation for the Pro Rata Rule, preserving the backdoor Roth strategy. Next, let's recap the key takeaways. Here are the key points. First, mixing pre-tax IRA balances with backdoor Roth conversions triggers the Pro Rata Rule, increasing taxes. Second, keep pre-tax dollars in 401k plans to preserve a clean conversion pathway. Third, follow a repeatable annual process and file Form 8606 to document basis and conversions. Fourth, Consider the Rule of 55 for penalty-free access to 401k funds if you separate from service at age 55 or later. Now, let's summarize everything in a final wrap-up. To summarize, the backdoor Roth works best when you maintain zero pre-tax IRA balances. Avoid rolling old 401k funds into a traditional IRA because it jeopardizes the tax efficiency of your conversions through the Pro Rata Rule. Prefer using your current 401k for roll-ins or leaving assets in the old 401k if it is cost-effective. Always document your contributions and conversions and file IRS Form 8606. Finally, review your plan rules and the tax code each year to ensure compliance. As we close, I have one final request. If this video helped you avoid a costly tax mistake, please like the video, share it with a colleague who needs it, and subscribe for more straightforward strategies. Drop your questions and your own experiences with rollovers and backdoor Roths in the comments so we can learn together.